Have you ever looked at a chart and thought, I wish this thing could just tell me what it's going to do next? What if I told you it actually does? You just have to know how to listen. Welcome to our discussion on Candlestick. Patterns, one of the most powerful tools in a trader's toolbox. Candlestick patterns are not just random shapes. They are the market's secret language, telling stories of fear, greed, and momentum. By the end of this video, you'll be able to speak it fluently. Before we dive into the specific patterns, let's break down a single candle. Originating in 18th century Japan for rice trading, each candlestick contains a wealth of information. It's a battle between buyers and sellers, and each candle shows you who won that specific round, whether it's an hour, a day, or a minute. Now, let's see what happens when we string a few together to tell a bigger story. First, let's talk about bullish patterns. These suggest a potential price increase and often appear during or after a downtrend, signaling that buyers are stepping in. One example is the hammer, which is a single candle pattern. It has a small body at the top and a long lower wick that's at least twice the length of the body. It looks like a hammer. This shows that sellers pushed the price way down, but by the close, buyers aggressively bought back in, rejecting the lower prices. It's a sign of potential reversal, but it must occur in a downtrend. Another bullish pattern is the engulfing pattern, which is a two-candle pattern. The first is a small red candle, followed by a large green candle that opens below the first candle's close and closes above its open, completely engulfing the previous day's price action. This is a very strong sign that buying pressure has overwhelmingly taken control from the sellers. Finally, let's look at the evening star, a three-candle reversal pattern. First, a long red candle in a downtrend. Next, a small-bodied candle called a doji or spinning top that gaps down, showing indecision. Finally, a long green candle that gaps up and closes near the middle of the first red candle, confirming the reversal and that the bulls are now in charge. But remember, a pattern in isolation is just a shape. Its power comes from appearing in the right context, perhaps at a key support level, for example. Now let's flip it. Bearish patterns suggest a potential price decrease and often appear during an uptrend, signaling that sellers are taking over. With this knowledge, you can start to decode the market's secret language, giving you the edge as a trader. So keep practicing, and soon you'll be fluent in candlestick patterns. Are you ready to become a rock star in the world of trading patterns? Let's dive into some key formations that can help you read the market like a pro. Let's start with the hanging man. It may look like a hammer, but its story is entirely different. When this pattern appears at the top of an uptrend, it's a warning sign of exhaustion. It indicates that, despite buyers' attempts to push the price up, sellers have come in and driven it back down. This is a crucial signal to pay attention to. Next up, we have the bearish engulfing, the evil twin of the bullish engulfing. After an uptrend, a small green candle is followed by a large red candle that opens above the first candle's close and closes below its open. This shows complete domination by the sellers, making it a classic get-me-out signal. Now let's talk about the pessimistic morning star. First, a long green candle in an uptrend. Second, a small-bodied candle that gaps up, showing indecision. And finally, a long red candle that gaps down and closes deep into the body of the first green candle. When this pattern emerges, the party is over, and the bears have arrived. Before you go, let's discuss the doji. This is when the open and close are virtually equal, creating a cross or plus sign with a very small body. The doji signifies indecision, suggesting that the battle between buyers and sellers has ended in a stalemate. It may not mean much on its own, but after a long run up or down, a doji can be a massive warning sign that the trend is losing steam, and a reversal might be on the horizon. It's like the market taking a deep breath before its next big move. Now that you're acquainted with these patterns, it's vital to use them wisely. Remember, don't trade in a vacuum. Look for these patterns at key support or resistance levels for stronger signals. Also, confirmation is king. Don't jump the gun as soon as a pattern forms. Wait for the next candle to confirm the buyer's control. Keep in mind that these patterns are not magic. They are probabilities, not certainties. And as always, this is not financial advice. do your own research, and have a risk management strategy in place. Patterns are just a piece of the puzzle, not the entire picture. If you found this masterclass helpful, hit that like button and subscribe for more content that simplifies complex trading concepts. Thanks for watching, and until next time, trade safe.